Welcome. Good afternoon to this webinar to discuss the Climate Tech Portfolio Fund 3 with Carbon Equity. So what to expect today? We will introduce this fund to you, tell you more about the market opportunity and how we want to play with this fund specifically in this domain, and also want to give you the chance to ask the questions that you might have. So for that, please feel free to introduce yourself in the chat. And if you want to ask any questions, use the Q&A section, and we will either address them along the way or we wait up until the end. But we do encourage you to ask any questions that you might have. So what is the agenda for today? First of all, we will discuss the climate investment opportunity. So what is it we're trying to go after? What is the problem we want to solve? What's the scope of the opportunity? Then secondly, what's the role of private equity, and where does this fund play in that universe? And then thirdly, we'll go a little bit deeper into the fund. So what is the strategy of the fund? How do we want to diversify their approach? What are the terms? And also introduce the first two commitments that we've made. Then we'll discuss how we select funds. So what is our impact approach? What is our general investment approach? Because it's a huge domain. So making sure to pick the right funds is important. And then finally, we'll explain you how you can get started if you're interested. And then finally, we'll open up for Q&A. So today, it will be, besides myself, Carolina, one of the investment team members, who will present to you. We have been with Carbon Equity since the start, so we can walk you through our experiences and ask any questions that you might have. I'll now hand it over to Carolina, who will discuss the climate investment opportunity.
Hi, everyone. Nice that you'll be able to join us today. So I'll first walk through the problem we are facing and then the solutions that we have to address it. So we'll keep the bad news to one slide, we always do, but I think it's good to give some context on just the massive scale of the problem we have to solve right now. So you might know, but currently we emit about almost 60 billion tons of CO2 emissions per year. And ideally, we should take this to zero by 2050. And you can see on this slide, basically, there's a lot of different variation of outcomes that could happen depending on how much we're able to decarbonize our economy. And it really does matter where exactly we land in this range. So currently, basically, if we do nothing and we remain with business as usual and current policies, we'll land somewhere around 2.5 to 3 degrees. If you see on the right of part of this slide, basically what a 3-degree world looks like, 3 degrees means the average increase in temperature globally. But actually, as you know, climate change is about the increased variability in temperatures and weather events that we witness on a day-to-day basis. So actually, that means that we will see temperatures rise up to 7 degrees in certain parts of the world, which could prove those areas uninhabitable. So it does matter that we try to push this curve down as much as possible to get even closer to 2 degrees, hopefully 1.5 degrees, where these variability will be much smaller and you can actually only get to maybe 2 or 3 degrees increase in temperature per day. So that's the problem we need to solve. Luckily, where there is a big problem and a big challenge to solve, there's also a big opportunity. So in order to decarbonize our global economy, which includes things from energy production, how we produce materials, how we eat, how we move around the world, to decarbonize all of that, we will need trillions of dollars in investment per year up to 2050. And in turn, we think this will drive massive growth in revenues coming from climate tech companies. You can think of technologies such as renewable energies, electric vehicles that are already fully or being deployed globally. And we expect new markets to emerge. Go to the next slide. Just a few examples of the markets we expect to grow substantially in the next decades. First one example is the sustainable aviation fuel market. So sustainable aviation fuel is essentially the alternative for jet fuel, which we put in planes that can either be made from biomass or from CO2 that we capture from the air today. And actually, there's already mandates, particularly in the EU, there is a mandate that starting from 2025, meaning next year, All planes that land on airports in the EU must contain at least 2% of sustainable aviation fuel in their blend. And this percentage will increase gradually every 5 years, getting to the point of 70% SAF in blends by 2050. So this is a market that is basically being at least forced by governments, because aviation is one of the most polluting industries in terms of emissions. And other governments such as Singapore are already following suit in terms of these mandates. So we expect this market to at least increase 15 times in the next decade. And similarly, green hydrogen is one of the technologies that is being supported by governments and where we're seeing a lot of traction. Green hydrogen is the backbone for a lot of things in a decarbonized economy, including sustainable aviation fuel, but can also help to decarbonize heavy industries such as steelmaking. And we expect this market could even increase by 80 times over the coming decades, reaching over $100 billion in market size. That gets us to our next point. I've mentioned only a few technologies that we need to get to net zero, but the good news is that we actually know what the roadmap looks like if we want to decarbonize our economy. There are several institutions like the IPCC, of course, but also McKinsey, that have developed plans on how we should and we could get to net zero. And the technologies we need to achieve that are already either in labs or in early innovation phases or even commercial today. So we think the private markets and really venture capital, private equity and infrastructure funds can play a big role here. So for example, 40% of the emissions reductions we need to achieve, we can achieve by technologies that are already out of the lab, maybe still need a bit of development to get to commercial scale. And you can think of, as I mentioned, sustainable aviation fuel, but also decarbonizing, for example, concrete and steel. There are already companies that are tackling this, and venture capital funds are in the right position to finance them until they're really at large scale available. Once you go into the commercialization stage, where you can see almost 50%, so 45% of the emissions reductions we need is already commercially available technologies. And here we think growth equity funds, private equity funds, and eventually infrastructure funds can play a large role in getting this to really the global deployment stage. So I'm assuming you've read news about electric vehicles, of course, but also energy storage, heat pumps, technologies that are now year on year increasing rapidly. And we hope this will move on and join solar and wind at the global deployment stage. And to dive a bit deeper into the current state of the private equity industry, I'll hand over back to Wiebe.
Yeah, thank you, Carolina. Yeah, so the private markets, in our opinion, play a critical role in transitioning the overall economy to net zero. Carolina mentioned a few of these names already: venture capital, private equity, infrastructure. So let's dive into each of these different types of private equity and the roles that they play. So the earliest ideas, like the spin-outs from universities, also need funding. These are more concepts, and there's no actual product, there's no pilot plant. This is really the earliest it can get, and we call that seed funding or pre-seed funding even. That's within venture capital the riskiest, but also needed to get any new technology up the maturity curve. A little bit later, once a technology has been proven in a lab and needs some scaling to a first pilot plant, we call that early growth. It's within venture, but it's an early growth stage, and only once it's proven at pilot scale and you need to build the first plant, then it becomes growth equity. That's a little bit in between venture capital and private equity. Companies are gross margin positive. Mostly still loss-making though. So they need scaling, they need further growth, and growth equity helps them scale further. Now, once the technology is proven at scale and the companies are typically more profitable, then private equity can play a role in really rolling out the technologies further across the globe. Now, for certain technologies that are very capital intensive, there's an infrastructure segment that requires different type of funding, not just equity funding, not just debt funding, but also project financing. And here you should think of new green steel plants, for example, really large plants. That's more infrastructure-like investing. But also battery storage at grid scale. That's infrastructure-like. Proven technologies, scaling them up, rolling them out. The fund we're talking today is really more focused on the first two buckets, venture capital and private equity, and less so on infrastructure. Now, most of these companies that we are targeting are not publicly available. You cannot invest on a stock exchange in these type of companies. So by investing in private equity funds, you can get exposure to these type of companies. And the vast majority of these companies are actually held private. So 99% of all companies are privately held, and many funded by venture capital and private equity. So just to give you an example, venture capital is driving innovation, like in Noon Energy. So this is a company that is developing a new technology that can store energy for a much longer period of time than lithium-ion batteries, the standard currently. So really up to 100 hours. And we need that to stabilize the grid. But Soli, for example, that's a growth equity investment. It's a company that's really bringing renewable energy to the masses across Europe. So it's a big play. It's proven technology. It's just scaling fast and making sure that the adoption increases across Europe. An example of a buyout company is Vakuumschmelze, and one of our funds invested in it is Arab Partners. This company makes magnetic materials needed for batteries. It's a profitable business that just needs scaling, and it's closely linked to the EV industry. Just to give you an examples of different type of technologies, different phases, but all of them need capital to further grow. And it's been a growing segment. So within VC and PE, focused on clients, close to 150 billion has been invested in the past 4 years. But that's a big number. But if you look at it as a percentage of the overall private equity market, this number has really increased from 6% to 15%. So it's really becoming a more dominant area within the overall private markets. And there are a few drivers right now that make it a more attractive space to invest in, beyond the huge opportunity just from getting to net zero, but more specifically now. It's the big programs from, for example, the US government, the Inflation Reduction Act. There are a lot of grants and subsidies and funding being provided to these type of technologies to really boost the transitioning and to help these technologies grow. But at the same time, we've seen valuations come down. So yes, there's a lot of non-dilutive financing, as it's called, but valuations have come down versus 2021 when everything was too hot and too many investors were chasing the same deals. So it's a more sensible time now to invest, and we feel pretty good about the dynamics therefore in the current market. That said, not all funds will succeed. And especially in venture, but also in private equity, it matters to select the best funds. Those are the ones that are really driving the returns. And being able to get access to those funds, to pick the right funds, is critical to perform better than the public markets. You might still do well if you don't pick the best funds, but not outperform the public markets. And you take a little bit more risk, so you want some outperformance. So this is a good time to introduce our Fund 3. Because this is exactly what we try to achieve with our fund. We want to offer you the chance to invest in the best climate technology funds out there. So we pool tickets from various investors, and with the pooled capital, we pick the best funds out there with a team of 7 who does that 24/7. Typically, these funds are difficult to access, so you need at least 10 million to get in them, sometimes 5, but large tickets, and not many people can invest those type of investments in a single fund themselves. Getting access to the best funds takes time. We have now screened over 600 funds globally, and we pick 7 to 10. So most of them are no's, and a few are yeses. But it takes time and effort to get access to them and to select them. There are also a lot of new managers coming to the market each time, so it's rapidly evolving, so you need to be on top of it. And especially on the climate side, having a view on which technologies are making a dent ultimately is critical when assessing these fund opportunities, and we have that in-house. So with a commitment to our fund, you will invest in ultimately 7 to 10 underlying funds, and these funds will then invest in companies. So ultimately, the entire portfolio will be over 150 million of investments. Then let's talk a little bit about the cash flow profile. The way it goes is you invest on day one, or you commit to a fund on day one, but it takes a couple of years before the underlying funds will actually deploy the capital. So the first couple of years is just investing. And only after, let's say, probably 5 to 7, maybe a little bit longer, the first companies will be exited. So it takes very long. It's a long period of time. That's the main difference, liquidity-wise, with investing on the stock market. So you need to be aware of that. Break-even point, put it here at 8 years. That's based on historical data. No guarantees, but it gives you a feel for the type of cash flows you can expect from investing in a private markets fund of fund. And then at the end of the fund life, most of the companies will have been sold, or the shares have been listed on the stock exchange and been sold, and the money is returned to investors. And there you will achieve the capital gain in the final years. So how will we diversify the fund? It's across various metrics. First stage, we will have some early stage venture funds in the program, maybe 2 to 4. Typically, these are a little bit smaller commitments given the risk profile. Then the bulk will be in growth equity type funds, so 30 to 50%. Really Series B, Series C rounds. So a technology is proven at a certain scale, but just needs more funding in scaling up faster. And we will also have some commitments that even target later stage companies, buyout companies that are pre-IPO. And with that, we believe it's a balanced mix across the entire stage. Then we have a 10% reserve for co-investments. We can occasionally double down on certain companies in our portfolio that we have very high conviction. The benefit of doing that is that we don't have to pay performance fees and fees to the underlying funds on those co-investments. So it helps the return of the fund a little bit. From a geographic point of view, we target 50% Europe, 50% US, maybe a little bit more US ultimately, given that the opportunity set is somewhat larger there. And then importantly, by sector, we try to cover all the sectors based on their emissions. So energy is an industry, are heavy emitting industries. So the underlying funds that we target typically will also focus on solutions for those type of sectors. But to the same extent, we also go after buildings, transport, and food and agri. A little bit lower, but ultimately with the 7 to 10 funds and the 150 to 200 underlying companies, all these sectors will be covered. Carol, maybe you can introduce the 2 funds that we have committed to so far.
Yes, happy to. So our first commitment out of the Climate Tech Portfolio Fund 3 was into DCVC's Climate Select Funds. So if you don't know DCVC, they're one of the first deep tech investors in Silicon Valley. They were founded over a decade ago. They've been investing in early stage companies with hardware, really complex business models across multiple sectors. So not just climate tech, but also biotech, cybersecurity, defense, AI, machine learning, healthcare, for example. Really a broad array of hardware technologies. And they've been doing this, as I mentioned, for 14 years now. They've raised about 12 funds to date, covering early stage, late stage, and different sectors. They were now raising their first climate-focused program, which will be an early growth strategy. As Wiebe mentioned, this will be the bulk of the investments out of our fund of funds. So DCVC will tackle Series B and C stages in climate tech. We see this Series B, C stage in climate tech as actually one of the main gaps or opportunities in climate tech right now, because there's a lack of funds willing to invest at that stage or able to invest at that stage. So we think DCVC has a fantastic opportunity ahead of them. And we chose to invest with them for a couple of reasons. So first, when we were looking at the fund, they had already made 6 investments, which is a quite large part of their portfolio, given they're targeting about 12 investments in total. And several of these had material traction already that we could see. I will go into a few examples later. DCVC has also hired a fully dedicated team for the climate select strategy led by Wiebe Visser. She comes from very established venture capital firms such as Carolina Ventures, and she also spent a long time as an engineer at Tesla in the early days. And the co-lead of this strategy is Rachel Slabo. She's a nuclear engineer who worked at Cyclotron Road, which is basically the incubator program out of UC Berkeley. And she was also at ARPA-E, which is essentially the US Department of Energy's R&D program for advanced energy technologies. So a very experienced team in the investing, operating, and scientific side within climate. And as I mentioned, DCVC has been investing in similar sectors for now 14 years. So they've been doing this quite successfully. To give you a sneak peek into the kind of companies you can expect from DCVC, one of their investments is Fervo Energy. Fervo Energy is developing advanced geothermal energy projects. So geothermal energy essentially means you're drilling wells to leverage the heat that can be found underground in the earth, putting water down pipes to get into contact with that heat and eventually create steam, which then creates electricity. Fervo Energy is implementing a lot of innovative technology, actually derived from learnings from the oil and gas industry. They're based out of Houston. And they're the leading geothermal company right now in the climate tech space. They had a first pilot plant of 4 megawatts that has been fully sold to Google to power one of their data centers in Nevada. And they're currently building a larger commercial scale facility of 400 megawatts, so really 100 times the size, which has been already fully sold out to one of the largest utility companies in California. So that represents over $30 billion in offtake over the next 15 years coming from that project. They have received $100 million debt financing last week to accelerate the development of this project. And a second example is 12. 12 produces sustainable aviation fuel, which I talked about at the beginning of this webinar. 12 actually only last week announced a major financing event of $645 million provided primarily by TPG. TPG is investing $400 million into their first commercial scale project as project financing and $200 million as Series C equity financing into the company to accelerate growth. So they're indeed building their first facility out of Washington State, and they also have a large offtake agreement with IAG, which is the holding company of airlines such as British Airways. And this is an agreement that 12 will supply the aviation fuel coming from this plant for over 14 years, with first deliveries expected next year. So as you can see, DCVC is investing in these companies that are really ready to massively scale up, either having built or building their first facility, which is usually already sold out to major clients. Our second investment was into Giant Ventures, which has some similarities. I will mention why, but Giant Ventures is a younger organization that has so far been focused more on the early stage part of the market within broader themes as well. So primarily climate, but also some healthcare and financial inclusion investments. And their first seed stage fund has been performing very well compared to some of their peers that we see in our internal benchmarking analysis. And now they have raised their second early growth fund, which is focused also at this Series B stage, but a bit more focused on more capital efficient business models. So they may do some hardware deals, but primarily we will see software or hardware light technologies that Giant is investing in. And this is something we deliberately try to diversify on as well. Next to the variables Wiebe mentioned, we think most of the transition will be solved via hardware, of course, but software can also play a big role in enabling the deployment and lowering the costs of the deployment of hardware technologies. So as I said, Giant will focus on the scale up of these kinds of more capital efficient companies. And when we invested in the fund, they had already made 3 investments as well, which I will again mention a few examples. So the first investment they made was into Agrina, which is currently one of the largest platforms that helps farmers implement regenerative agriculture practices. This increases soil carbon, so the amount of carbon stored naturally in soil, which allows farmers to create an additional revenue stream by selling carbon removal credits to corporates. And the second investment is Sire. Sire is developing a textile-to-textile recycling technology, currently focused on polyester. So polyester, as you may know, is a fossil-based textile. So its production accounts for almost 1 billion, so about 500 million tons of emissions per year, actually. So Sire is able to take end-of-life polyester textile that we already use today and recycle it into new polyester clothes, creating a closed-loop system. Sire has recently announced a $600 million offtake agreement with H&M to buy their recycled polyester clothes. Besides Giant and DCVC, we've actually already made 2 other fund investments, which we can't disclose at the moment, but we will be announcing them over the coming months. The other 2 fund investments are one in a European private equity fund manager, which is an energy transition focused strategy, a bit more later stage growth and buyout type deals. And the second fund that we've approved after these is a US early stage investor focusing on seed and Series A technologies. So providing the exposure to the more kind of in development technologies that we mentioned earlier in the webinar. And we've also, besides these 4 fund investments, approved 1 co-investment. So as you saw in the slide where we had our strategy, 90% of our portfolio will be deployed in fund investments, but we expect up to 10% to be deployed in co-investments, meaning we can selectively co-invest alongside our managers into companies. And the first company was a very competitive transaction in the building insulation sector. So actually, it is a vacuum insulated glass technology that can really save material energy savings for commercial building owners. And that was a Series B round that we'll be announcing over the coming weeks. So as you can see, we've had a busy year so far with the Climate Tech Portfolio Fund 3, but that's not where we're stopping, of course. We already have a very attractive pipeline of funds to look at right now. There's a snapshot on this slide, but I think the most important thing to highlight is that we see a very well diversified pipeline right now. Across stages, we see early stage, growth stage, and late stage managers in Europe and North America, covering the full climate tech sectors and investing in both hardware and software. So we expect to have very good opportunities in the coming months. Now, moving on into how we actually select the funds that I just mentioned, I'll walk you through our fund selection process. So in the past, let's say 3.5 years that we've been actively investing in climate funds, we've evaluated over 450 climate funds. Yes, there are that many. And I think we expect a couple more hundreds to start fundraising in the coming years. And we've only invested in about 20 climate funds to date. So only 4% of the funds we see actually pass it through our full diligence process. In our diligence process, we're always assessing the same topics. So we're looking at the investment strategy of the funds, the team managing the funds, how it is set up organizationally, the financial performance, of course, and also how it is set up from a climate impact perspective. If we decide after a quick scan analysis, which is a kind of high-level 2-page analysis on a fund, if we decide to move forward, then we actually always start with our climate impact process, which I will detail now. So our climate diligence process consists of 2 elements. First, we assess how well a fund is integrating impact considerations into their own investment process. So we want to see that at every single step through their investment process, funds are thinking about, does this technology matter for the energy transition? So for example, this starts right when they're defining their investment strategy, but also when they are starting to source for deals. Do they have an investment thesis of where they think they should be investing within the energy transition? And as they do their own diligence on deals, are they quantifying the potential impact that a technology could have and comparing this to alternatives to really also optimize for climate impact next returns? Are they using that information for decision making? And even after their investment, do they have processes in place to monitor and report on impact information? That is one part of our climate impact due diligence, which is really looking at the process side of things. And we think this is really important because when we invest in funds, as you have seen, maybe they've made a few investments but the bulk of the portfolio will be invested, of course, after we commit to a fund. So it's very important that they have solid processes in place that we are comfortable that they will continue to follow throughout their investment periods. Moving on to the next one. The second part of our climate impact due diligence is to actually look at deal by deal the companies that a fund is investing in and whether we believe that these are technologies we need to get to net zero. So for that, we do our own analysis on what we call the potential contribution to net zero. Essentially, we're looking again at two main things. One is the size of the problem a company is addressing. So is a technology really focusing on a material and an important greenhouse gas emissions issue? And if they're doing that, is the impact of this technology net zero aligned? So we don't only want them to address a big problem, of course, but also to be able to solve it fully, or at least solve it to a degree that is aligned with the 1.5 degree or 2 degree pathway. And if these two things are met, then we say a company has a substantial potential contribution to the net zero transition, which is really the metric that we are optimizing for in our investments. And we aim for at least 80% of underlying investments to meet this benchmark, but in practice, we almost reach 90%. Once we are fully comfortable that our funds will achieve its climate impact goals, we, of course, continue with our financial due diligence, which is a broader assessment of an investor's ability to properly and successfully deploy a fund, and, of course, assessing their historical financial performance. So on the one hand, we're looking at the team that is deploying this fund. They should have relevant complementary experience, as we saw, for example, with DCVC, and a strong historical financial track record in the sector that we're looking at. We expect an institutional setup from an organizational perspective with solid processes in place in terms of, for example, valuations, but also with a strong network of advisors and other limited partners around them. The investment strategy should be coherent and should make sense in terms of portfolio construction for the size of the fund they're raising and for the stage that they're investing in. And they should have defined processes on how they will source deals and credible processes on how they will add value to portfolio companies, which we, of course, also reference with CEOs. And lastly, the terms of the fund, so the commercial terms, the management fees, for example, should be market standards, and there should be enough alignment within the team, let's say, in how they're compensated. Maybe diving a bit deeper on the analysis we do financially on company by company. So similar as we do on the climate impact side, we also go deal by deal on the financial side to understand with fund managers what lessons they've learned from prior investments. This is venture investing, so we expect a few things will go wrong, hopefully not too many. But if they do, we try to understand what happened in those situations, if they could have been prevented, and that helps us judge the investment ability of fund managers. We look at the companies in the portfolio, not just if they've been able to continue to raise capital at higher valuations, but also, of course, if they've been performing well in terms of just their fundamentals, revenue growth, if they're profitable for later stage funds, and if they've been able to meet key milestones on the technical development side. We look at the valuations that fund managers are paying to be able to invest in these companies. We track this across our portfolio, so we're able to benchmark which funds are really negotiating on valuations and which ones may be paying up a bit too much that would probably not meet our criteria. And as I mentioned before, we will do several reference calls, primarily with CEOs and portfolio company founders, to confirm that what we've heard during our due diligence process is indeed what they've experienced. And we will, of course, do also reference call with other limited partners or co-investors with the fund to really get a full picture of their abilities. And you've met Wiebe and I in this webinar. We're both part of the investment team, but there is a much broader team that is really dedicated. So the 8 of us on the slide on the left-hand side, we are the investment team of Carbon Equity. We have over 60 years of private equity experience and 20 years of climate impact experience. We're by now probably the most active investor in climate tech focused funds. And we've been able to get a very good sense of the market over the past 4 years.
Great. Thank you, Caro. So hopefully you're excited now and want to know, so how can I invest? Well, before we get there, let me walk you through some terms and conditions, also a very important part of the offering. So the fund size that we're targeting is 125 million. We've already closed more than 60 million following the first close, so we're almost halfway. Like we explained, there will be 7 to 10 funds ultimately in there and some co-investments. And typically the fund sizes of these underlying funds range between 100 million and 5 billion. That's the typical underlying fund sizes. Now the timing, the first close we completed in June, second close is anticipated for October. And then we will have a final close towards year end. The duration of the fund is 12 years, and we can extend it, that's optionally, by 2-year extensions. And the target net return is over 2 times money multiple, 2 times your investment. So how does it work? The underlying funds that we go after, they tend to target at least 2.5, and for the early stage funds, over 3 times net. But there are also some fees and expenses that need to be deducted. So taking those into account, we try to achieve over 2 times. Obviously, we cannot guarantee these type of returns, but from design, that's how we select the funds themselves. So really go after the ones that target at least 2.5, and for early stage funds, at least 3 times their money. So what are the associated costs? Where's a one-off setup fee? So it's 1% of the commitment, and there's a 25% discount for recurring investors on that setup fee. And then we charge an annual management fee. And that number depends on the size of your commitment. So it ranges from 30 basis points for very large tickets, so the 20 million, all the way up to 95 basis points for anyone who invests below 100K. There is a second close discount, so that's a 25% discount also on the setup fee. So we do encourage you to join the second close if you're keen on that discount. And to the next slide, so on the capital calls, we will call the first 25% of the commitment at close. However, there's a minimum of 100,000 euros that we need to call upfront. So if you commit 100,000, we will have to call the first 100,000 straight away. If you commit 400,000, we will start with 100,000 on day one. There are, of course, risks involved. I described it already when discussing the cash flow profile. It's illiquid, so long duration. It takes time before you can monetize your investment. That's by far the biggest risk, but also the underlying companies, they are at various stages of maturity, and especially in venture, there will be companies that will not make it all the way up to the end. And that will there will be others that will make it, and those should make up for the losses. But that volatility within portfolios is something to be mindful of. And what is the minimum ticket? It's 100,000 euros, but we have some exceptions. So for German semi-professional investors, it's actually 200,000. But you can invest below 100,000, so 50,000, if you qualify as a professional investors. And we can share more information what the criteria are to meet that hurdle. So if you're still interested, what are the steps? First of all, you can create an account if you haven't done so already. And then you will receive an email to activate that account. You can then assess all the fund information. There are presentations in there and other materials in the data room that we have shared with you. And then you can book a call and have one-on-one conversation if you'd like after this webinar to go through your questions, your concerns, or any other topics you'd like to discuss. And then if you have considered the opportunity and all the associated risk, you can reserve your investment very easily online. It's a digitally done and it's a very smooth process. Now, the deadline is October 9th. By then, we want to know if you want to invest. So please start today and walk through this process in order to meet the October 9th deadline. Then I also would like to highlight the ambassador program. So this is another way to lower your fees. If you refer someone who also comes into the fund, then both of you can claim a 0.05% discount on the yearly management fees. So not just on the one-off setup fee, but on the yearly management fees. There's a maximum of 5 people you can refer though. So the maximum discount on the management fee is 0.25% per year. So that's quite material. So we do encourage you to refer the opportunity to friends. Yeah, I think with that we arrived at the Q&A section. Carolina, have there been any questions so far? Anything?
No questions right now, but just as a reminder, you can use the Q&A button at the bottom of your screen to submit questions, or you can also, of course, put them in the chat. We'll stay online for those who have questions.
Yeah, and if not, then of course feel free to reach out, set up a call, go through your questions one-on-one. Maybe give them one more minute opportunity, see if there's anything.
Yeah, I see now one in the chat from Martin. He asks, how much are you planning to invest in secondaries?
So within this fund, we do not anticipate any secondaries. And if we would do a secondary, it could potentially be one very early on. So in year 1 or 2 of a fund from an investor who seeks liquidity. But we're not going to invest in secondaries in year 4 or year 5 of a fund life. There are not that many opportunities out there, and we have not seen any of those type of opportunities yet. So the market is still not mature enough to create that much of deal flow from secondaries in this domain. No, if there are no further questions, then I'd like to thank you all for your attention and look forward to discussing the opportunity further with you. Please feel free to reach out for those one-on-one calls, and then we'll like to go through any questions you might have there. Thank you very much.